Hi, everyone. Hello, Warriors. Michael Schneider, Mike Delfino, Sinatra, AJ, Brand. How are you guys? Everyone doing okay? Team, how's it going?
Hey, Dale.
Hey, Dale.
Is it Friday yet? No, I don't think it is. So,
Dale, at your age, you can call any day a Friday.
well, thank you for that privilege, and thank you for bringing up my age. So, someone said I was fatherly yesterday. So, better than grandfatherly. Did you buy this breakout?
No.
Okay. Yields up again today. Yen's trying to reverse from 135. Maybe this is it for a while. I wouldn't be able to turn bearish yen unless I saw it back under 33. Ryan, what do you think?
Yeah,
is that the level you need to take out?
It's the steps, isn't it? You know, we've got a step at 134, we've got a step at 132, we've got a step at 131. And it'll keep going higher, these steps. So we're definitely into the clouds, both technically and on that. But 135 is holding for now. There's a bit of a trend line if you draw it from that 20th.
Off the tops.
Yeah.
Kind of like a wedge line. So this was,
a bit. Yeah.
Oh, you mean from here?
I think I need to look at my chart actually.
These two tops connected up here, or does it go back to here?
It goes back to the 20th of March, 22nd of March. So back a bit further. Back a bit.
Yeah, right here.
No, bit further.
That's the 31st. 29.
Next highs. There we go. You're getting there. Back
here?
a bit.
Okay. Okay. So this is what Ryan's looking at without him having to bring up his charts. So you're looking at this. Okay. So you have this channel working right here.
Yeah.
All right. Got it. And it's had a nice run. I mean, it should be, at least this action so far is not that great. Even though, I mean, it's still a nice up day. I guess under 134 is your first, that seemed to have been a level it held yesterday that some would say might be a breakout. So I think 34 is the bull bear line for now.
Yeah, give it down to 80 perhaps. Those last few highs that you said we've got it held back in 10th, 11th April, and then we got the break and it's holding again. So technically it's doing what it should do when a market rallies. It makes a break, it holds the break, makes a break, holds a break.
Talking about not being able to get through the cloud or falling from the clouds, there's gold. I think it's going to attack this long-term breakout line at 1930, and silver really approaching this very important technical level of 24.5. So
hey Dale.
Hi, how are you, Steve?
I'm good. How have you been?
I've been or I am okay.
Good. We did get some warnings, right, about an upcoming pullback. We talked about it, and we're seeing this unfolding as we speak. I think this will be giving us a buying opportunity. So
what are your levels?
So I think it's a welcome development. My level for gold, technically speaking, is a full retracement of the ascending wedge, so a move back towards 1935.
Okay, so you're calling this kind of a wedge line here?
It is an ascending wedge, mate. I've indicated that days ago.
Okay, 1935. Where's about? I mean, I know it's a wedge. It was a 3-drive. 3 drives always happen in wedges.
Yes.
So, okay, so
1935.
Okay, well, this is I agree, because you see this blue line here.
Yeah.
Blake gave it to me. Well, he gave it to everyone that was watching him that day, or showed it, that that's a major breakout line from the highs, the all-time highs, and then the last correction. and it's viable because after it broke out, I like to see if things at least check it and what the reaction was, and it was a good reaction.
And
so
having to do with silver, first soft support is the one we're currently testing at 2460, 2470.
Yeah, that's
but I think we should probably see 24.
Okay.
Again. So I think that's then a good level.
Okay. So you have Steve's levels, and there's most likely levels underneath as well. I don't know if you did fibs or anything. I think I did.
Yeah, although I think for silver it's going to be very tough cracking through the broken multi-year channel. Of course, since it's a descending channel, for every day that passes, that trend line moves a little bit lower. So it's currently already below 24. So we can see levels below 24 as the trend line is slipping below 24.
I think fibs could be a good guide right now.
But I think I think it's more important to just notice the trend line. I don't think we're going to break back below it. So
and you're talking about this uptrend from here to here, these two lows, this low.
No, I am talking about the descending trend line resistance that capped and defined the correction for years.
Okay.
There is a descending
next
channel.
Time you want to break in, I have a suggestion. Take over and show your charts.
There you go.
So I don't have to play Kreskin and try and figure out what
Kreskin, what's
your
that?
lines are.
There you go.
Do you know Kreskin? You don't, Stel?
No.
Well, he would. Do you remember the Johnny Carson show?
Yes, he is Johnny.
He was a mentalist.
Oh,
so not a mentalist like me, where I have psychological issues. But he was able to. But he was, he'd be able to read people's minds and things like that.
I assume you can see the
great
yes, yes.
Oh, okay.
Okay.
Yeah. Okay. All right. Oh, yeah, that's nice.
So that's what I'm watching, and I'm looking for a possible retest of that as a great buying opportunity.
Just under 24, huh?
Yeah, currently just under 24. We've been looking at this for days now on the morning edge.
Did you short it, anticipating the drop?
No, absolutely not. There is no way I'm going to be shorting any metal. I'm only a buyer, not a seller.
I thought you were a buy. You could do both. So
I'm absolutely straight, and I only do buy in metals.
All right. So do you think the dollar is giving you enough evidence now?
I think we're going to be seeing, we talked about that on the morning edge yesterday, that I'm not convinced that the dollar rebound is over. That's what I said. I think we might see a little bit more of a rebound. And I'm happy we're seeing it because, as I said, I was looking for better opportunities to be long silver specifically. I'm looking to buy silver on the financial markets. So I'm.
Do you watch any silver miners? You ever try the miners?
No. I think it's much better if you're not a very, knowledgeable person on the industry specifically. I think it's a much better bet to go for SIL, which is a basket in essence,
ETF.
right? Yes.
Okay. The ETF. SILJ is the juniors and SIL is the majors.
Yes. And it's a basket in essence because it contains many miners, so you don't have to take the individual risk of a specific miner failing or something, right? Because in an industry, even when things go well, there can be a couple of bad apples, right? And you don't want to be in one of those, right?
Yeah. Okay. Your view on yields. Why have you? And then I want to get Kay in here.
My view in yields is this: 3.6% is resistance. We're currently testing the ground above it.
Yeah,
we break
looks like the end.
Yeah, we break and close above it, then we open more upside. 330, we had indicated that it was like key support area.
Yeah.
So once 330 held, I had a clear bias to the upside because the risk reward was amazing, and the chances for yields to slip even further and diverge even further from the Fed funds rate was a very slim one, right? So the move higher from 330 was the easy type of trade. But now that we're at 360, it's not as easy as it was back then. You know what I mean?
Mm-hmm.
Because it will all depend on, every data point that we get from this point forward readjusts the market's perception about how fast and how much of a pivot we're going to see from the Fed. Needless to mention that any re-emergence of
banking
of banking issues, etc., are going to obviously accelerate any such assumptions, right, and perceptions about future rate cuts. So 360 resistance. Let's see what we do with it today.
Okay, and I think it was, someone showed me a Joseph Wang piece, and he actually thinks that Union Bank, which is a pretty big bank here in the U.S. In fact, I have I have an account with them, and that they are ripe for failure. No one's talking about them. In fact, they were part of the contribution of all the banks that got together. They contributed to stake some capital at, I don't know if it was SVB or
if you're asking me personally,
yeah,
I think I think that the vast majority of the banks,
even the big ones,
can potentially fail, because after so many years of, in essence, a completely manipulated bond market and the inability to get yield unless you do stupid things with your balance sheet,
right? Yeah.
I think that the vast majority of the banks are extremely vulnerable to any type of normalization, right?
All right. I once asked you about bail-ins, and your comment was that those days have passed. Do you still believe that?
Bail-ins depends on what you're talking about. Bail-ins, are you talking about including depositors? Because then yes, yeah,
that won't happen. So they'll nationalize the banks if the whole system. That's what's going to happen.
The political damage would be massive if there was a deposit bail-in.
Yeah. Exactly.
Okay. How about pension funds? Because they own all these bonds. They're in trouble.
Don't worry. Don't worry about pension funds. First of all, social security is completely bankrupt.
Well,
right?
I'm not. No, that's like not even. That I'm talking about people that worked for a company.
No. I understand.
Listen.
Everybody. Politicians are going to make sure that everybody gets their money back. They can guarantee that. There is one slight problem though. Everybody's going to take their money back. Now, the purchasing power of their money is a totally different story.
Yeah, so to do that, that should really be occurring.
Yes.
During the bear market.
So everybody's going to get their money back over time. There is absolutely no worries about that. Now, how much their money is going to be buying in comparison to when they were doing contribution or whatever, that's where they're going to be hit massively.
Okay, how about this compromise? And I've heard it's being bandied about to prevent these runs, that they're going to limit everyone, individuals, as to how much they could withdraw over a certain period of time.
I don't think so. Okay. I don't think so, because this is going to be the beginning of a
great reset.
A huge scare, and it's going to ripple in ways that will be uncontrollable. So I don't think so.
Okay, so everyone's worried about U.S. banks, but the narrative was, and then I'll turn it over to people that could help our attendees make money. But the narrative is for years now. The U.S. banks, they cleaned up their balance sheets. I don't know what they did with all the derivatives on their books. That
you can grab your screen back, by the way. Go ahead.
Okay. All right. So they were in better shape here in the U.S. and Europe never did that. They never really cleaned up their balance sheets. And can you imagine? I can't imagine that banks didn't make the same mistake in Europe, and even exacerbated by they bought stuff when there were negative rates.
Mm-hmm.
Okay, so at least on the losses in the U.S. they were getting 2%. So can you imagine carrying that paper and how much principal loss there is? And you don't only have principal loss, you have to pay to maintain that position because it was a negative interest rate piece of paper.
Yeah, I'm telling you, banks are. I mean,
the whole banking system globally, you're pretty bearish on here.
Listen, the problem is the following. Once they started manipulating the market, so they solve some other self-inflicted issues and wounds, right?
Yeah.
They killed the traditional banking model. They killed it. Yeah. Banks could not anymore make money doing what banks were doing for hundreds of years, right? And once that happens, experimentation begins, and that entails big risks. And this is one now of the huge obstacles of normalizing rates and normalizing the economy. I mean, I'm extremely bearish the banks in the sense that there are huge risks involved, right? So it's an industry I would not touch even with somebody else's money.
Well, guys, this has been an enlightening and very, very awesome conversation, but we are running out. We're about 13 minutes before the interview.
Yeah,
and I want to know how to make money today. So,
okay, well,
yeah. I mean, how am I going to do that with the banks, Steve? If I'm not gonna buy them, I got to be shorting them, right? Or am I just staying away? What are we going to do with the banks?
I'm not. As I said, I'm not touching the industry. I wouldn't be touching the industry.
Every now and then, I think it's good to talk about the theory, right, behind the big picture. But yeah,
what do you think about the Bitcoin dump on a failing rally?
Well, I think a lot of things about a lot of these failing rallies. Actually, you got the Ethereum that rolled over. You got Bitcoin. You're right. That's right at the breakout point. Matter of fact, my alarm's
Wile E. Coyote there, Blake.
What's that?
Wile E. Coyote.
Wile E. Coyote. Yeah. Well, you talk about Wile E. Coyote. I think that's pretty much the market in general. We are we are near the 4,200 level. We tried to break higher. You can see the S&P trying to break higher. We're actually nearing channel support. This has been the channel that's really kept us in play, not being bearish for like the last several weeks. We're getting close to that support, and you're starting to see the dollar firm up, even following all this European data. So, Ryan, K-Man, what did you guys think? And Stelios, what did you guys think about the UK inflation data? European inflation data came out stronger. Everything reversed following that. What do you make of this price action? Let's start with you, Ryan.
What I make of it is, as I've been saying all along, the inflation in the UK is going to be sticky. It's going to be much higher than everywhere else. It's going to be harder for the Bank of England to combat it, and they're going to fail.
Yeah, but so why did the cable rally and then roll over?
Because for once, the UK data led everything else. We saw a lift in US yields, European yields, obviously sterling yields. Everything popped on that number, and when you look at when you put the US and the UK in a set of scales, the US comes out on top. You look at so cable flapped around, but you look at the sterling crosses, and it's a different story. A lot of strength there.
Okay, and so the cable rolled over, and Europe had some pretty good inflation data as well, and that rolled over too, right?
Well, inflation's going the other way in Europe. We've had big whole percentage point drops in some of the numbers, but the market's pendulum swinging, and it's been sitting in the pause cut side of things, and now it's going into the pause hike side of things because it's seeing other countries like New Zealand talking about sticky inflation. It's seeing core numbers sticky, everything's sticky. So, you know, these pauses are now potentially going to lead to more hikes rather than cuts. And that's obviously, when you're talking about the Fed, that's where everyone's going to run to.
All right. Well, so let's ask, K-Man, I want to get your opinion here. The dollar, you know, hey, good morning. We worried about the dollar. You know, everybody and their mothers, brothers, uncles, monkey is bearish the dollar. Last week we talked about it's maybe a little too bearish. We've seen a nice reversal in the dollar index off of these lows. Do you think this is it for the dollar? Do you think the dollar could actually stage a recovery here? Or do you think that we got to be selling the strength in the index as a whole?
I'm just going to repeat. I think we are in ranges right now. Yes, this repricing of expectations in yields virtually every day. So today it's in favor of the dollar. That I think is also why cable is a bit lower. But then, as we spoke about on the flow show, if you look at the sterling crosses, they are still doing better. If you look at euro crosses, they are not really falling out of bed either. So for the for the dollar, it's a bit of a tough call. But I'm just going to take one example, and this 134, call it 34 and a half, 35.15 or so. You could even stretch it to 35.40 on the dollar yen is pretty important because the top of the cloud is at 134.45 of the daily cloud, and then we've got all those that channel coming up, and for the time being it looks to be rejecting, because I've showed this morning in the room as well that there's a lot of yen pairs, a lot of yen crosses which are on relatively important levels, and it goes from the sterling yen over euro yen over Aussie, Kiwi, CAD yen, you name it. They're all at important levels. So if you look at the dollar, I think again we are going to have to differentiate which one to look at because of all those crosses. And so for me, the dollar versus, call it euro, sterling, perhaps also yen, is going to be relatively range bound for now. That's my view. I like to buy the dips in the dollar. That's one thing. Because also if we look at the dollar China is very close to breaking higher. I like to buy dips for now in the dollar, but I don't know if we are going to have like too many legs. As already mentioned before, if you look at the US 2-year is on resistance, US 10-year is on resistance. This could just be one range play for now.
All right. Well, I thank you for your opinion there on the dollar, and I agree with you. The dollar, I think you have to be careful what you're trading it against. It's not going to be a one size fits all. Ryan, what's gonna dislodge us from this range bound activity, do you think? What's going to be the deciding factor which way we break?
It's probably going to be confirmation from the Fed in terms of the dollar, because you know the market saw that the Fed were taking rates higher, and it still sold yields and sold the dollar. Now we flip the other way. I mean, you can tell how much of a mess it is. I mean, the people who are supposed to be in the thick of it, the banks, the big financial institutions, they're supposed to be the ones who know what they're doing. JP Morgan last month said that the ECB would only get to 3.5%, and that was pulling their prior forecast down from 3.75. Yesterday, they said the ECB again at 3.75 again. Morgan Stanley said the BOE were going to pause in May. Now it's a 25 pip hike in May. Deutsche Bank said that the BOE would have one more hike to 4.5. Now they got another hike to 4.75. The banks don't know what's going on. So how are we expected to know what's going on? The only people that know what's going on is the Fed. So we have to trade this noise around, picking our levels, seeing where the resistance and supports are, until we get to the next big meeting where we hopefully get a bit of clarity and the market moves again.
Well, I think I know what's going to dislodge the market, to be honest. I'm
going
out
away?
of town. I'm going out of town this weekend, and so when I leave on Thursday night, the market should absolutely crap the bed on Friday. So if you guys are really looking for some volatility, just wait till I leave my desk. We have just 5 minutes before Dale's interview, but Gregor Horvat's joined us. He filmed the week ahead video last week. He also filmed. He's going to film the week ahead video this week since I have to go out to Texas this weekend. So Gregor, what's your opinion here technically? Hey, what are you looking at specifically that's got your attention right now?
Well, I think that the dollar is in a recovery mode, especially after this failure push higher that we talked in the webinar last week, presented on the euro dollar. So what we have seen recently is that crude oil has topped back on Friday last week. Okay, then also at the same time we have seen a top on gold. DXY obviously bottomed at the same time, but now what we are seeing that stocks are now also trying to turn down, trying to catch somehow this dollar strength. So if really the S&P 500 will roll over, you can see a very nice wedge here that is in play in a wave 5. So I think if this black trend line, if we close below it today, I think that this will bring on more dollar strength. Also, we are seeing VIX index, about it talked in this week ahead video as well. VIX is still at the lower side of this 2022-2023 range. So it looks like the market is a little bit too confident regarding the bullish call. So I'm afraid that we have the opposite in front of us.
Yeah, we're right into that support zone. So Gregor, really good looks that you have on the market.
Gregor,
yes.
Hey, how have you been? So you're also looking for these moves to be corrective in nature, right?
On the dollar or where?
Both dollar and equities.
Yeah, but I think the dollar just made the first leg of the minimum free wave recovery. So I think that gold, silver, all of those, I mean, gold specifically came out of this wedge. And as I said, if stocks will also, which are somehow slow, will drop, I think that this will just accelerate the dollar. So I think that there is plenty of room for more upside. Not to mention very weak commodity currencies, which in my opinion also has room for plenty.
Yeah, commodity currencies have remained weak throughout the recent rally we've seen. That is quite peculiar.
Yeah, so I mean, if stocks would really drop, then you know what it means.
Yeah, more pain.
Yeah, exactly.
So Gregor, when you're looking at the metals, because let me ask Stelios. Stelios, you this morning, you're in the chat room. By the way, if you guys want to see what our chat room looks like, this is Stelios we were just talking about precious metals, and he was talking about how he was picking up a position, also mentioning it in the trades room here. This is where everybody's kind of posting what they're buying and selling. Then we also have the Flownomics room, which is the macro chat room, news and research. But the general chat room is where you're going to find myself and a lot of the other guys predominantly. Stelios, you say you're buying some silver here. I've been looking for, after this Gartley completed, I was looking for a move back to 2450. I expect a bounce here, but could we get lower? Could we even go towards, this triangle retest would take us to 2370. And then Gregor kind of scares me. He's talking about, the dollar really forming a bottom. And if that's the case, precious metals would go a lot lower. What are your thoughts here on silver?
Yeah, well, I was buying the position that I sold at last week at 2562. And I was buying it when it was in the 2460, so about $1 lower. I think we could go lower. We could retest. Initially, I was looking at 2380 to 24-ish, but you know me, I get itchy fingers, and I decided to get most of that position back in there. It's actually good because we're back up to 44.90 now. But anyway, yes, of course, we could pull back to 23.70. My medium-term view is unchanged on silver. I'm just jobbing in and out as much as I can. I'm holding longs and I get out and then get back in and then buy dips. I keep doing that. Of course, we can get to 23.70. I don't think we'll get to 20, as our friend is writing here. but you know, the way I traded is unleveraged and big tolerances in terms of stops and in terms of the profit targets. Yes, Bran, I am scalping, but the market is basically giving me that opportunity to scalp. I don't do it often.
So you got itchy fingers, but you know what you get when you
Yeah.
pick bottoms. You get smelly fingers.
It's okay. My average long is below 23 now, so I'm pretty comfortable with that with this position at the moment.
All right. Well, good to know. And I actually see this, 2370, this triangle retest is probably going to be a pretty big deal. I mean, if you look at it from a Fibonacci standpoint, I bet you that's about a 38% retracement of this last move, which would make total sense to me, which it is. 2375 would be the 38% retracement of the entire move. We're at a 24% retracement right now, which, I tend not to pay too close of attention to. But yeah, I could definitely see that. So maybe a little bit further recovery in the dollar. Dale, I know you have an interview coming right now. I just want to say, first of all, if you guys haven't checked out the trader funding program, make sure you do that. In a recession, as we're heading into a recession period in 2023, more than likely, why would you want to risk your own money? Risk our money. See if you can trade. If you guys think you're a good trader, try to take an assessment. This way you'll be in the ForexAnalytix community, and then you can braggalicious in the chat room how you pass the assessment, and then you get to trade our money. So I hope you can pass the assessment. I hope you can brag. So check out the trader funding program. I want to thank Stelios, Steve, for your banking thoughts, Stelios for your silver thoughts, Grega for your LOA thoughts, K-Man for his dollar thoughts, and Ryan for his
lack of hair.
No hair thoughts. I love that too. Just kidding, Ryan. I love how you keep our head on a swivel at all times. And Dale, thanks for hosting us every day. So you guys have a great day. I'm going to see the ForexAnalytix subscribers. I'll see you on the morning edge in 45 minutes. Dale, have a great interview.
Thank you, Blake. Thank you, team. We have it all cased, but we want to hear from Tim Vollins today. Tim, welcome back to F.A.C.E. How are you, buddy?
Hi, Dale. Yeah, really good, mate. You?
Good. Listen, there's a rumor flying around the company that you're going to be changing your Twitter handle to the leaf blower. Is that true? And why leaf blower? What does that have to do with it? What?
Just a bit of fun.
Okay. Anyway,
yeah, the way the world's going mad.
I think they should execute the guy who invented them. All right, they're the worst noise pollution in the world. Anyway, Tim, what's top of mind for you? We're about a month into the spring.
Yeah, I think I'm right there with you guys on the uncertainty. To be honest, it's really it's a tricky time at the moment. I think.
Do you want to share your screen and show us your confusion?
I can show you my confusion. Yeah, no problem at all.
The either or. There are a lot of markets that look either or, but do you think that I know you're okay? We could start with the S&Ps here. Any bias here on this rally? I could see how it could trade 4,300, and I can see if it takes out 4080 that it's going to have problems.
Yeah, I mean, this is the thing that I've sort of. It feels in one way, it feels like we're becoming complacent. Okay, in a lot of things.
Oh, you mean like the 17? Yeah, 17.
Yeah, VIX is coming down. There's a lot of things when you look around as well. Just published an article on just random things that we look at, like home builders. Some of these home builder stocks. The big guys like Lennar and D.R. Horton. They're near their all-time highs. And you're looking at that and thinking, well, why would they be there late cycle? Who's buying home builders late cycle? And I think we're just sort of getting to a point where perhaps there's a bit of complacency that we're going to get those rate cuts early, that the economy's, we're going to have this inflation, the economy's going to hit a soft landing, and then we're just going to take off again. And, I can kind of see that based on, I'm skeptical. I mean, it's one of those things. It's like you look at things that are possible and things that are probable. And I just don't see it as probable. Given the amount of tightening that we've had, and just the general volatility of everything, the data, what's been going on. We've sort of gone from this massive bull market into, a really sort of fast retracement down, right down to sort of 3,500 in the S&P. And now we're back up where we are now. You go, okay, so where's there good value for a trade? Is the way that I look at it. More of a kind of swing trade, and you think that there probably isn't great value until we can kind of look at a clearer picture. There's no real bias right now. If we get back down below sort of 4,000 again, maybe even down towards 3,800, then yeah, you think, okay, I would like to be long, maybe around the 200 daily moving average there. But up here at the moment, you just look at the way the market's moving. And to me, it looks like we want higher, and with the VIX low and everything else. And I think perhaps we're pricing in the Fed pause and that kind of return of certainty, which we know markets love. I think there's elements of that there too as well, that we know, or at least we think we know what the Fed's going to do, which is, 25 and done. And then they're going to sit there for a little while. So yeah, I think that's what we're doing. And I think maybe, if we get to sort of 4,300 area, then I think that's a short. I think for me, depending on the data and the situation at the time, the context, but realistically, I still think there's the majority of the pain economically is ahead of us. We haven't really felt that pain yet. And we're seeing the credit tightening coming through now. I mean,
we should get the, I forgot who it was who was a consummate bear because of, was it Wilson? Mike Wilson
because of earnings. Yeah.
And, he's still singing that song, but he says he's not bearish anymore. So, I mean, haven't all the bears kind of capitulated? I don't know who's left. I think the guy from JP Morgan, Marco, might be one of those last guys left.
It's ironic, really, because he's always been the permeable.
Isn't it really going to be about the dollar? There's an expression, if you get the dollar right, you get everything right. And what do you think?
I think that generally is right. But what I also think is, at the moment, the dollar's the hardest thing to get right, because we're going to rely on everything else against the dollar now. If you work off the assumption, which I think is a fair assumption, that the Fed are going to pause at the next meeting. They're going to hike 25 and then they're going to pause, I should say. That's what I think they're going to do. We're priced at like 85-90% chance of that. I think they deliver it and they get to sort of that magical 5% that they've all been going on about for, a few months now. And then they're done, I think. And they're probably, with their inflation sort of, the inflation picture in the US versus other economies, I think then it's fair enough for them to be done and say, we're going to hold here. But then you look around and you think, okay, well, what about Canada? What about Australia? Which they're looking, they want to hold, but they're kind of, inflation's pushing them to maybe do a bit more. You look at the UK today, especially, again, inflation's pushing them to do more. And I think that, even Japan, I mean, I'm not all over this one. I think it might be overhyped, shall we say, that the Bank of Japan will do something, but they might make another adjustment. And I think you're looking at everyone
so
else.
Saying
I think the Fed's going to sit there. Yeah,
interest rate differentials are going to continue to not favor the dollar because of that.
Potentially. I think what we're looking at is that all of the catalysts are going to come from outside of the dollar. Is what I'm thinking. And then we're sort of, they're maybe going to feed in, because obviously on the other side of that, if you start thinking, okay. I mean, one thing that I looked at especially is obviously Japanese insurers and pension funds buying US debt. It's not looking too good at the moment. For the costs of hedging it, with the FX and everything as well, are very, very high. So especially at the long end, it's really not very appealing. So maybe we're actually maybe we see higher rates in the long end now of the dollar, which I think would be dollar supportive without a doubt. But again, there doesn't seem to be that at the moment, at least, there doesn't seem to be that catalyst to really push to that. Maybe higher inflation elsewhere, maybe even PMIs at the end of the week. We might see that actually economies are sort of pushing on again, and maybe that will just drive rates globally higher. But yeah, and sort of almost ensure the crash.
How about the geo risk of Ukraine worsening?
I just don't know the markets really care about that too much at the moment.
That's what I mean. They don't care at all.
No,
they don't care at all.
I mean, how would you see it worsening, Dale? If you think about it, really, it's like I can't see it sort of getting much worse than where we are now from a market's perspective. I don't see how it could really get worse. From
all the NATO
from
countries
Ukraine.
all the other NATO countries are doing drills. Looks like they're getting ready for something.
Right. Okay. So
that would do it. That would do
yeah.
it.
I mean, war would definitely do it. Yeah.
Yeah. Well, that's what I'm talking about. If NATO becomes involved in some way. Anyway,
that would be huge. That would definitely.
I know the market only cares about the Fed.
Off.
That's what I mean. Everyone's eyeballs on the Fed, and we're whistling past the graveyard with a lot of other things happening. Are there any sectors within the S&Ps? Because I've been top picking semis, which really led the way. Do you do sector work or just trade the indexes?
No, we do look at the sectors as well. But to be honest, again, it's very, very messy. I think semis definitely is going to come under a lot of pressure. I think you're bang on with that.
Why?
Just because of the overall situation with the inventories, there's oversupply. They're still spending out fortunes in building more capacity. I don't know. Did you see the ASML earnings this morning?
No.
Okay, so ASML were very, very, very strong. ASML, obviously, the company, just in case anyone doesn't know, they're the ones that are basically selling the shovels. They're selling the machines that make the semiconductors to the TSMCs and the Intels and so on of the world. And their earnings and their pipeline as well are very, very strong. So that capacity really hasn't come down. And I think it's just sat there. And as soon as there's a little bit of a spike in demand, then they're all rushing to try and meet it. And it will just keep our race to the bottom on, and in the end, no one ever wins in a race to the bottom. It just sort of compresses margins. So
even
Nvidia, I think that's a good one.
Even Nvidia, Tim, take a look, pull up the Nvidia chart.
Okay. I did a little thing about Nvidia a little while ago. Yeah, it's a very clear hype.
Well, I'll tell you what, I'll tell you what I see. Can you put is that a daily?
That's a daily chart. Yeah.
Okay. It's a classic 3 drives to a top formation. First down day is a signal. Can you go make it a little? Yeah, there you go. Now you'll see the 3. So if you had the RSI underneath Nvidia, it's making its second lower high. And this has been the superstar of semis. Okay, so is that an RSI? Simple moving average. All right, so you've got 3 drives there, and 4 hour even shows it better. And you'll see the formation that I've taught a couple people this one. Yeah, so you had that spike up yesterday, gapped up, and look at the non-confirmations glaring.
Yeah.
So the orange line. So semis. Anyway, I think semis, how do you divide a semi and make it a quarter? I don't know. Semi is half, right? So, and the miners, you trade that stuff, gold got hammered today.
Yeah, the miners is one that I don't ever trade, but yeah, I've been very wary of gold up at these levels as well. Again, it's just don't see the kind of the real need for the follow through. Just doesn't. You're looking at you say, okay, so what are we looking at globally? We're looking at globally at the moment higher interest rates. There's no real signs of kind of greater financial repression, which I think of gold as a hedge against. So why are you going to own a zero yielding asset? When inflation is coming down and real interest rates are becoming more, well, I was going to say more positive, but really less negative is the correct way of framing it.
I bet Steve Volge would have an answer for you.
Go on. What is he listening?
It looks like he's here. He's he spies on me now during my interviews.
What's the question, Dale? Sorry.
Okay, so give Steve your reasons for why would anyone buy gold? Go ahead. One more time.
Okay, so buying gold up here. So why would you buy gold when globally interest rates are pretty stable at higher levels than they have been, and the sort of real interest rates with inflation coming down are also getting less negative?
Because I believe that real interest rates are going to go substantially lower. Inflation might actually move to the downside, but I think that rates will aggressively move to the downside more than inflation will, sooner rather than later. And I think the precious metal market is already pricing that in, has started pricing that in.
Okay.
We've
so
already
seen
stagflation. We've already seen the Fed within a single week undoing 4 out of 8 months of quantitative tightening they have done. And in my opinion, it's a matter of when and not if they're going to go back to quantitative easing.
Okay. Yeah, fair enough. I don't necessarily disagree with that over time. But yeah, I'm not sure that this is the place to be kind of adding to that bet.
Short term, perhaps not, but in general, I think the trend will continue. I think 2023 is going to continue being a very good year for the metals. We've seen silver break through a multi-year corrective move literally a few days ago. We're seeing platinum be in the precipice of doing the same. I think this is going to be a good year for the metals, personally.
Okay, excellent. Definitely.
Thank you, Steve.
Keep an eye on. Thanks, man.
My pleasure.
For leaving your meeting to answer the question. There's a dedicated gold bull. So anytime there's a bear on, all I have to do is unleash Steve on them.
Yeah. I mean,
Steve, thank you, man.
My pleasure. I'm here.
Yes, I mean, the other side of the way that I sort of think of gold, and again, this probably is, I think, a little bit further in the future, is that generally what happens if we do go into a kind of, a proper recession, not this sort of mild recession that we've been talking about, but, a genuine downturn. Maybe, we're talking sort of more towards the end of the year, I think, before we can start credibly talking about that. But in that situation, do people continue holding gold? And I think much will depend on what inflation looks like then.
Yeah.
And again, I mean, this is something that we mentioned yesterday. Hang on, let me just see if I can bring it up here on the screen. Okay, here we go. So obviously, this is you can see this here, my mouse on the screen, yeah?
Yeah.
Okay, so what we're looking at is obviously now inflation by sort of June time. Just purely on a mechanical basis, because we're getting rid of these big months. We're going to be below 4% on the headline. Obviously, core might be a different story. But generally, headline inflation, which is the one that's mainly reported.
And in the twos next year.
Yeah, I mean, again, I think a lot depends on the evolution of the economy there. I tend not to try and forecast too far ahead, and I think most people should take recent experiences to sort of show that that's not a good idea.
Did OPEC change the dynamics of the oil market bear a few weeks ago?
Of the bear, definitely. In terms of the bear, definitely. I just think that, again, you've just sort of got that situation where everyone's kind of trying to play off against each other, but I don't see any trends really forming at the moment in anything.
Right.
I just sort of see that it's going to be chop, false breakouts. Again, maybe we're seeing decreasing volatility as well, generally across the board. But obviously, at some point, that volatility compression usually ends up being, having the opposite effect, of course.
Do you think it's a liquidity too? I mean, I watch the S&P trade. They don't trade as tight as they used to. There's times I see one handle moves between trades.
I do think that's a general dynamic actually across markets. I think as well when you saw the same thing in the oil market after
and the bond market. And the bond market's the worst, right? People can't hedge as much as they did just because of the bid offer. I mean, that used to be the tightest spread on the planet.
Oh God, yeah. And some days it would barely move.
Yeah, 64th or 32nd. Anyway, the times they are changing. So what do you think about as far as all this talk of de-dollarization and it really causing people that would never really consider or be worried about the dollar? I'm talking about the man on the street asking experts, do I have to worry about the dollar? Do you take that as a contrarian signal right here that there's, funds are real long, things like euro, real bearish dollar. Can the dollar stage a pretty good rally in here?
I mean, I think it can, and I think it will at some point this year. I just don't know again that we're right on that spot just yet, because generally the dollar obviously strengthens in times of sort of credit crunches. When anyone needs liquidity, they need dollars basically. And I think the de-dollarization thing it's always misguided. People look at things and they see a couple of countries, oh, they've done it in yuan or renminbi, or they've done a trade in a different currency, but that's not what it's about. And it's only a tiny amount of trade anyway. The biggest problem for these countries, the ones that are supposedly going to move away from the dollar, is that they generate excess savings. And they have to put those savings somewhere, and because they've got a trade surplus, they can't. That means they've basically got too much. They haven't got the capacity in their own economy, or sorry, they're overcapacity in their own economy. So they have to look elsewhere to invest, generally speaking. And obviously, with the US being the biggest economy with the largest capital markets, it offers them the greatest amount of opportunities to save those earnings. And that's really what it comes down to with the dollar status. It's not what people think it is, that like the US goes around bullying the rest of the world and saying you've got to use our dollars or we're gonna bomb you, or whatever the sort of recent narrative will be. It just doesn't work like that. It's constraints that there's no other economies that can take those savings. And China's a great example, because China hasn't got open capital accounts and they run obviously the largest trade surplus of all of the economies. Then that's basically you've got a choice of putting your money into the US or kind of a tiny, sort of trying to put a little bit here and a little bit there around the world. And, there's all sorts of political constraints in those other countries a lot of the time too. So the US is the least bad option sort of all of the time. And until something drastically changes, that will continue to be the case. It's not about politics. It's about constraints.
Okay. So should there be a storm, you think the US is the best place to ride it out?
Always.
Recession always has, always will be.
Until it's not the biggest economy in the world with those markets, I agree. I mean, you've got things coming up. We've got a bit of drama coming up with the debt ceiling now. I think we're due to find out how the tax collection's been as well. I think that's today. Whether the Treasury is going to run out of money in June or July or when it's going to be, supposedly.
Yeah, I heard June.
Yeah, but some of that depends on the tax receipts as well, of course. What they're bringing in now. So obviously, the bigger the tax receipts, the longer they can keep going. But in the end, it will get resolved, and then we'll move on, and everyone will forget about it again. But I can still see there being a bit of drama and maybe a bit of panic around the same time.
Okay, there's only one. Okay, you added panic. Everyone, most people with that narrative feel like nothing to worry about, even market wise. That it's just theatrics and it'll get done. But we've had theatrics lead to downgrades by Moody's before. So, and there are repercussions from a downgrade, right?
Yeah, absolutely. Absolutely there are. I mean, I doubt that. I say that, maybe I've got too much faith in the politicians, but I doubt that they're going to let it get to that point, because it's election suicide to be the one who blocks it.
Good point. Okay, sometimes self-inflicted wounds happen without intending to do it. I don't think we've ever had a Congress like this. So, anything you want to wrap it with, buddy? And tell people where they could follow you and.
Yeah, I mean, there's a couple of things that I would say that the biggest thing to watch at the moment is availability of credit. In my opinion, if you're looking at tracking how the overall economy is doing and how markets are going to do, that's the thing to sort of consider. This is something that we did here on back in February. Right, this is a lagging indicator. It's not a leading one. It's just something to kind of consider. Right, that I think everyone knows the financial conditions are starting to tighten. Although people will tend to bring up these sort of indices, but there's all kind of problems with them in terms of how they actually measure what we'll call real economy financial conditions. Okay, a lot of these they're very stock market heavy. So basically, if the stock market's going up, these are going up, and they say, oh, financial conditions are getting easier, but they're actually not. Okay, so we're starting to see credit tighten. We've been starting to see it since Q4 last year, This is just a survey of loan managers here, and you can see that generally, when we get this kind of spike, I mean, I know it's a small sample size, but we get this kind of spike up, it's generally leading towards a recession, right? Which I think everyone knows is coming. It's more a case of when rather than if, I think. We're all trying to time it. Say again? And the degree. And degree of recession.
What's your intuition telling you about degree?
I tell you, I think the longer the Fed stays on hold with higher rates, and tries to keep it up there to sort of the worse the recession is going to be. And I mean, not just the Fed, all of the central banks, it's just there's the rate of change is just too fast for people and businesses to adapt too quickly. That's
don't you think it would take,
really,
don't you think it would take, I mean, right now it's not an emergency, but first they're going to tighten and then, pause. But don't you think it's going to take 3,200 S&Ps for them to reverse and begin to, then there's an emergency showing up in the market, or they're going to be preemptive on just based on data points, or do they need a reason like the market under a lot of pressure, which is what they wanted that they really never got, for them to start cutting rates?
I actually think it will probably be employment that does the job for them. Okay. And rather than that would be the thing that says that where they turn around and say, okay, that's enough sort of pain in the employment market. That is going to tighten things enough.
What's
Obviously,
the number
inflation
there,
needs to come down as well.
What are they looking? They want to get up to 4.5 or so. They're trying to get it to.
That's what they reckon. But again, it's like, it's, I mean, how do you micromanage an economy to that extent? An economy the size of the US, how are you going to micromanage it to that extent? It's, these things, as we know, they happen with lags. Monetary policy works with lags. It's going to take time. And the problem is that we tend to, obviously, because it works with the lags, we end up with the policy from sort of 12 months ago. So obviously, the further along this we go, the higher sort of the higher the impact of the tightening rates is. And I just don't know that they're going to. I don't think that we're going to see necessarily sort of 3,200 in the S&P. I think that's extreme. By the time, I mean, if we actually got down there, then I think there's far bigger problems going on in the wider economy, and they would be taking all of the blame for it. I kind of have a bit of sympathy with Steve's view on gold and things, is that I do think that these administrations, should we say, in terms of the Fed and in terms of the current Biden administration as well, and the timing as we're going into elections next year, I don't really think they've got the bottle to really inflict a lot of economic pain. So I think that once we're down with inflation at sort of 3%, for a few months, I do think that they're already going to be making noises about cutting rates back to what they'll call a neutral level. So I kind of think the market's roughly pricing that correctly. I just don't know that they're pricing the timing of it, but sort of a return down to neutral rates, because they're seeing unemployment tick higher and they're seeing the impacts.
Can we see new? It doesn't sound like you sound pretty sanguine about the market. Can we make new all-time highs?
Not. I don't think so, unless we get another big fiscal spending plan, which I don't think is likely. No. I don't think so, because I'll be honest. I don't think that they want to do QE again. I think there's been a realization that QE does not lead to a healthy economy. I'm not saying they won't do it. I just think they don't want to. And obviously what we saw I think what we'll see is more of that kind of lending that we saw with the banking crisis. They'll sort of make facilities available to provide liquidity, to bridge the gaps, do that kind of thing, but not actual QE. I mean, there's a subtle difference. QE is free money, roughly speaking, into the system, and obviously it finds its way through. Whereas obviously a lot of that money was quite expensive. You were looking at sort of 4.5 to 5% lending rates there, which is fairly expensive bridging loans rather than QE that's stimulative.
Okay. All right, Tim, best place for people to follow you and David, Macrodesiac.
Come on, find us out.
Is Macrodesiac an aphrodisiac?
That's the general idea, yes. Sort of the love of macro, and
it's a financial aphrodisiac.
All right. Financial aphrodisiac, exactly that.
All right.
You know, and it's not all based on macroeconomics. It's based on just looking at things, trying to take a bigger view, you know, sort of a grander view of everything that's going on and bring it all together, rather than saying, because we're not big believers in macroeconomics or the economists always getting things right. You know, we're much more believers in everyone being fallible, you know, and in trying to find where those weaknesses are, and figure out what's actually going on under the surface and away from the sort of the models and the assumptions that underpin everything. So yeah, and it's when we love doing it. So that was why Macrodesiac came about.
It comes across, and your demeanor. I feel calmer after having a conversation with you for the last half hour. You're not, you know, there's nothing real dramatic. It's stated matter of fact, and you kind of bring, you know, myself, you know, that have like, you know, more extreme potential views back to earth. I think you're a great spokesman for your company as well, Tim.
Thank you. We might. I mean, if I'm making you feel calm,
I'd never call you a leaf blower.
Thanks, man.
You impart a lot. Yeah, Tim imparts a lot of wisdom every time he's here.
Yeah,
I learn from him.
Thanks,
Ryan, for getting me in trouble with Tim today.
You're not in trouble, Dale. But if I make you feel calmer, I might open a sideline, you know, macro therapy.
You know, I've spent plenty of time on the couch. So, Tim, really, best of luck for you and subscribers and followers, and to you during this spring trading season. And
likewise, same to you and Ryan as well. All of you guys there.
Speak soon.
Ryan's great.
He is.
And we'll talk in the summer.
Look forward to it, man. Look forward to coming back.
I'll need to be calmed down again by then. I'm pretty sure.
Yeah, I think the summer might be the last. Summer I think might be quite fun.
Yeah, it's emotional. Well, then wait till next year's election.
Oh,
so,
yeah.
We have a lot of fun coming down the road.
You've convinced me. I'm definitely doing the macro therapy thing. That's it. Right. We're all gonna need it.
Everyone, Tim Valens, you could follow him at Macrodesiac, and really appreciate you edifying our community, Tim. Good luck, my trading warrior.
Good to be there. You too, buddy.
Okay, so that's a wrap, everyone. You could join the team in 14 minutes on the Morning Edge, and good hunting the rest of the day. Enjoyed the eclipse. You know, I think it's happening right now. Do you feel that strange energy from the eclipse? Anyone out there? Or is my tinfoil hat is lighting up, and there are rays going between the tinfoil rabbit ears? All right, Barry, you're welcome.
Nice, Richard.
All right, anyway, let's end it there. Remember, don't just count those things, Richard, Brand. Count your blessings. I'll see everyone tomorrow. Adios.